Right, thank you, Helena, and welcome everybody to this webinar where we will be, as Helena has outlined, discussing climate risk disclosures in company reporting. I mean, I don't think it needs very much introduction from me to say that obviously governments at the moment are thinking extensively about how to tackle climate change and achieve the net zero emissions that they are setting themselves as targets. It's not just governments, it's society. I think it's society as a whole. So that includes consumers and the whole of society. And obviously that has I think what is clear is that there will be enormous changes to how our way of life really, and how we do things in the future. And these changes that we can start to see coming through now are obviously of enormous interest to the investors and owners of companies around the world. How are businesses responding to those clear signs that we have of change ahead, so that is in a way the context. And I think in April this year we held a webinar, a similar webinar to this, to discuss the issues, particularly with investors, and that was based on some research into the 2019 reports. What's happened since then, I think, is that we've seen this, the awareness of the issue and the importance of the issue increasing, and during 2020 we heard, for example, from some significant major oil companies, by way of example, in impairing some of their assets, talking about a strategic change of direction that they were implementing. So we felt maybe 2020 represents a turning of some turning of the corner, and the reason to hold, I think, this webinar this time is that we've been looking at 2020 accounts as well, and to see the extent to which those pressures are showing in terms of what companies are reporting. Now, both the reason why I'm here collaborating with Carbon Tracker, ACCA and the University of Glasgow have commissioned two reports, one on the 2019 reports, as I say, and now a follow-up research on the 2020 reports, and that looks at both the front half of company reports, the strategic report, MD&A, whatever, management commentary, whatever it's called, but also the financial statements, and that concentrates on the extractive sector, so including oil and gas, but also some mining. So mining and iron and steel companies are included in that. And then Carbon Tracker have been also doing research into large companies in a bigger range of sectors, and also covering some more geography, because we excluded in effect the US companies. So some different perspectives, but essentially looking at much the same issue. The Carbon Tracker report concentrates on what's in the financial statements. So that's the background, and what we're going to do today is to hear firstly from Diogenis Baboukardos, who is from the University of Essex, but is actually the lead researcher for our ACCA University of Glasgow report. And then we're going to hear from Barbara Davidson, who is senior analyst at Carbon Tracker International, on the research that they've been doing and the survey results that they have. That will then be followed by a panel discussion, and I have with me Nick Anderson, who is a member of the International Accounting Standards Board, and Alan Teixeira, who heads up IFRS research at Deloitte. So we'll, I think, get some reaction to the findings in the studies, and then have a panel discussion among us all on I think the implications of that, and that will include obviously picking up your questions that you're submitting in the question and answer box. Okay, well, with that introduction, I'll hand over to Diogenis now to give us the findings from the first of the studies.
Thank you very much, Richard, for that. Thanks a lot, and welcome everybody. As Richard already mentioned, I will present the findings of our follow-up report for the 2020 annual reports of companies in the extractive industries, which is financially supported by the ACCA and the Adam Smith Observatory for Corporate Reporting Practices of the University of Glasgow. This report has been done in collaboration with a lot of good colleagues in various universities around the UK. And in fact, this report is a follow-up report of the report that we already published in early 2021 in relation to 2019 annual reports. In that case, we focused on the 60 largest polluters in terms of their carbon emissions for the period 2016 to 2018. And we focus only on companies that they apply IFRS, so US companies are not in our sample. Now, in this report that I will present some comparative findings from this year and last year's reports, we focus on 56 out of these 60 companies, because for the 4 companies we didn't have their annual reports by the 1st of September. So what we have done, we focused, as Richard said, both on the front and the back end of the report. For the front end, we analyzed various parts, such as the business model, the scenario analysis section, if they have any KPIs in relation to climate change, and we analyze whether we find any climate change related information in all these parts of the report. Whereas in the back end, we motivated our research instrument to some extent by Nick's article back in 2019, in fact, where we on how IFRS already address to some extent climate change risk-related issues. And we analyzed the notes for the impairment testing for non-current assets, provisions, the relevant accounting policies, but also the audit report. Now, the big picture that we see basically is that we do have an improvement since last year, especially in the front end. Back in 2019, we found that the companies in our sample engaged with 39% on average from our disclosure index, whereas now that jumped to 50%. We also see a better picture in the financial statements, but the increase is much larger, I would say marginal. If we see by region, the results show that we have some regions that companies engage much more with this type of disclosures, with Europe being ahead of any other region, but also interestingly, Africa, primarily because our sample has only 3 South African companies, and South African companies, due to probably integrated reporting, they engage quite well, especially in the front end of the report. Now, when it comes by industry, again, we see some variation. Of course, as you can see on the number of observations by industry, we have many companies, more than half of our companies are from the oil and gas, and we see, especially in the integrated oil and gas, to engage better than the average company, whereas we see other sectors, such as the crude oil producers, basically not to engage so well. Now, if I move to the front end and to some specific findings from the front end, when it comes to the business model, again, we see an improvement in the disclosures. First of all, we see more companies having a dedicated section about their business model. And also, most of them, 44 out of the 50 these companies, they also identify addressing climate change risk as an important and integral part of their business model. Also, we find that there is quite a substantial number of companies that they explicitly consider international initiatives, primarily the Paris Agreement, in their discussion of their business model. Some other interesting findings from the front end is the number of companies that they provide KPIs in relation with climate change. This is what we found back in 2019. As you can see, 47 companies out of the 56 of our sample, they had this type of indicators. In 2020, we have 51, so we have some improvement as well. So we see that almost all companies engage with this type of indicators. Considering that an important issue is, at least for our report, is to see how much connected the front and the back end are, we also explore whether the KPIs that they are produced, that they are provided, they integrate, they connect some type of financial information to climate change related information. So we found that back in 2019, 4 companies, they did what we call full integration, in the sense that they had a KPIs that they combine financial and non-financial information, primarily carbon intensity, CO2 emissions to sales. Whereas we had also a number of companies that they provide on the very same page both financial KPIs and climate change KPIs. Especially in this second thing, in the partial integration, as we call, we saw that in 2020 there is we have an improvement in the disclosures. And finally, about the front end, we also see quite a substantial number of companies engaging with TCFD. And again, as you can see, from 24 having in 2019, we jumped to 37 in 2020. Now moving to the back end, I will discuss a bit about some impairment issues in relation to impairment. First of all, as you can see, it is obvious also from the very first slide of my presentation, the numbers are much lower than before. So we see that, however, we see that there is an improvement in the disclosure levels. So when it comes to assumptions in climate, in relation to the impairment testing assumptions, we see that 17 companies compared to 10 in 2019, they provide some type of assumptions in relation to climate change. A good example of that is the OMV company, where here you can see this snapshot from their annual report, where they discuss how they motivate this, that they take into consideration scenario analysis as they are aligned to the International Energy Agency policies, but they also provide strong, clear numerical information about their assumptions. In relation to companies that they recognized impairment losses in 2020, we have also 4 companies that they recognize climate change as being one of the factors that drove their losses. We had 3 last year. This year it is 4. Again, an example from Repsol this time, where they clearly recognize that the decarbonization of the economy is one of the main factors, and their attempt to address the objectives of the Paris Agreement is one of the factors that led to changes in the evaluation of their assets. Finally, with specific items, the key audit matter, the recognition of climate change as a key audit matter is also in an upward trend. back in 2019, we had 8 companies that their auditors believed that climate change is a key audit matter. Now that jumped to 13. And also this is an example, again, an extract from a Glencore, which happens also to be audited by Deloitte, where they clearly have a dedicated section in the audit report where they discuss exactly how the climate change might affect Glencore's activities. Now, coming back to a topic that I mentioned before about the connectivity of the back and the front end, I would like to bring a couple of examples on that. The first one is from Everest. Here, if you see on the right-hand side of this graph, you'll see that Everest provides what I referred earlier as an integrated KPI, in the sense that they combine the CO2 emissions in a KPI, their CO2 emissions with their sales, their total sales, which is the typical carbon intensity ratio that these companies provide, the companies at least that they have these integrated KPIs. A second interesting example of companies of good practice, let's say, of companies that they try to connect the two parts, the two ends of the annual report, is from BP. That part, this extract that you can see here, comes from the strategic part of the front end of the report, where they discuss about their price assumptions when they do their investment appraisal assumptions, and they clearly connect this to the back end and on how they do their impairment testing, which is basically the narrative of the impairment testing is over here. Now, that was more or less the findings, and I would like to close my presentation with 2 remarks, maybe a couple of issues that it might motivate our discussion later on. A bit more of a conceptual character, I would say. And the first one is about the capitalization of provisions. This is again an extract from one of the companies that we analyzed, and this is basically the typical approach that companies take in relation to the decommissioning and restoration costs. And under the IFRS, the companies they capitalize these costs against their provisions. Now, within our sample companies, there are a few companies that they made, let's say, an extra step on that. Instead of only recognizing their capitalizing their costs, they also have founded a trust where they basically save capital for these future costs. So a potential question is that wouldn't be reasonable to maybe push companies towards this direction, since in this case companies they will show more with real actions that they really engage in addressing the climate change risk, at least to the extent that the reporting can drive also the behavior of the company. The final issue that I would like to raise here, and I'm just becoming a bit provocative with my slide, that climate change risk is good, but that is just because of the application of the entity assumption and how it can really really apply in such a topic like climate change risk. In fact, what I'm writing here is nothing else than what this company that belongs to the copper industry basically refers to. This company being a mining company on copper, they expect to have better future financial outcome, simply because with the transformation of the economy, they will have there will be a vast higher demand for copper in the future due to renewable energy, due to the electrification of transportation systems, and so on. Which means that for these guys, at least in isolation, right, they will do better. And again, I know that this is just a very big and very complicated probably issue, but is this what we really try to achieve here? Is this what we really try to achieve by pushing for more sustainability report related or carbon or climate change related reporting? Do we want the companies to believe that they will do better due to climate change? So with that, I will leave you here, and thanks a lot for your time.
Okay, thanks very much, Diogenis. And well, we have an expression, it's an ill wind that blows nobody any good. I think it's bound to have some winners in there. And I think you're right. I would absolutely expect that copper might be one of those. Anyway, that's that report. What I'd like now to do is hand over to Barbara Davidson, who's going to give us carbon trackers findings from your study. Barbara.
Thank you. Let me just get to my screen. So thank you, Diogenis. That was really very interesting as well, because I think we looked at some of the same companies. So happily, I think we have similar results for those companies. I just want to talk briefly about a study that we're doing that we did talk about again in April, as Richard mentioned, and I'll go quickly through the background and context. The context is that the 3 of the 4 major standard setters have already provided that climate-related risks, material climate-related risks or matters are already covered under their standards. Investors, as Richard has said, have already asked for this information in 2020 financial reporting. The only thing I would add, and I think this may have been mentioned, but I would also add that these investors have asked companies to follow the requirements for auditing and accounting. So the auditors and their companies follow the requirements. They also asked for sustainable or Paris-aligned assumptions to be put into the financial statements and for auditors to assess those. So understanding that this is not a requirement under IFRS or US GAAP, we did also look for this information. And I think Richard did talk a lot about our scope already. We did coordinate our work with another team called the Climate Accounting Project. That is a team of accounting and finance experts that were commissioned by the Principles for Responsible Investment. And so we looked at 55 companies, they looked at 52. They looked across more jurisdictions and sectors than we did. We primarily looked in the energy, transport, material sectors. The one thing I would note about our scope or our population of companies is that so 94 of the companies we looked at are part of the CA 100 plus focus companies. The CA 100 plus is a group of investors that are looking at companies that to engage and influence companies that they feel have a significant effect or are significantly affecting climate change. And so these companies represent the 167 that CA 100 plus looks at, represent about 80% of corporate industrial greenhouse gas emissions globally. So we looked at 94 of those companies in our population. So we had an expectation based on the accounting standard setters, the auditing standard setters, and the population companies that we would see information in financial statements and the auditors would point this information out in their audit reports. We asked these 6 questions or 7, I suppose, as part of our review. Again, the one thing I would point out here, so the questions are primarily focused on what the requirements would have required these companies to do in their financial statements and the auditors in their audit reports. Adding on to that, we again looked for Paris-aligned assumptions and estimates or sensitivity thereto based on the investor requests. And we looked to see if the auditors assessed those assumptions and estimates for Paris alignment, understanding that these are not required today. We defined Paris alignment for the purposes of our study as achieving the preferred pathway of no more than 1.5 degree warming and net zero by 2050. So we had very specific criteria around that, and the report will talk more about that. So you're getting a preview of the report, and as was mentioned at the beginning of the call, these slides are under embargo until the 16th when the report will be published. So please don't screenshot them yet, but we will definitely put the slides on our website and you'll see the entire report there with the findings. So this is the findings for the first 3 questions we asked about the financial statements. And you can see we have color rankings with the red being significant concerns, the blue being few concerns. We had a 4th called good practice, but we did not find any that we considered to be good practice. You can see from the slide that there's still a long way to go. Most of the assessments we did for consideration of climate and financials, visibility of assumptions, or consistency with other reporting were not very good for the financial statements. The things we looked for in consideration, I think Diogenis also mentioned a lot of those already, but we looked to see if there were indicators of impairment. So if the company indicated that climate-related risks, transition risks, or even the company's own targets were indicators of impairment. if they assessed their own asset lives in the face of these issues, and also if they considered other effects, so effects on provisions, effects on decommissioning obligations, if those related to those companies. So those would be the qualitative information we looked for around consideration of climate. Then we looked for quantitative information around visibility of what we called climate-related assumptions. And again, those would be related to commodity prices that could be affected by climate-related issues, projected commodity prices, carbon prices if the companies have to account for increased emissions, changes to the actual changes to asset lives as a result of perhaps company targets that may result in shortened asset lives if they're going to retire assets early, and changes to production or demand that could affect these assumptions and estimates they use in the financial statements. And the third, as Diogenis has mentioned, is also consistency with reporting. So if they did have targets, did it look like that the timing of the targets, if the target is there's a net zero or there's a reduction in emissions, say for 2030, do the useful asset lives look like they're aligned with those targets, the assets that we think would be affected by those targets? And the interesting thing about the consistency reporting, and it wasn't just targets, it was also transition risks. So if there were regulations that would affect the company, does it look like the company has considered those regulations in the financials? If we would expect these items to be material based on the population of companies and again, the requirements. But the interesting thing about the consistency with other reporting is the amber, the some concerns, which is about 28%, actually doesn't represent consistency or levels. Some of it does. So about half of that is a level of consistency. The other half is a level of consistent reporting, but that's because they had very limited acknowledgement, if at all, of climate-related risks. So we did have some companies scoring, if you will, better in consistency because they just didn't talk about climate risks pretty much throughout their reporting. So that's a little bit of a misleading find for consistency. And the other thing we were thinking about with the consistency for these red is what does this suggest? So 72% did look like they did not have consistent reporting. Does this suggest that they lack proper governance around these issues, that they don't think that this is climate change is going to happen? Or does it suggest that there's potential greenwashing if they do have targets? How serious are they about these targets? Oops, sorry, skipped ahead. These are the audit reports. So we looked at auditor consideration of climate and if the auditors did a consistency check in accordance with the relevant standards, understanding that there are differences across jurisdictions, so with US and non-US audit standards. So here for the audit reports, we looked primarily at the key or critical audit matters, because that's most of the time where we expected to see this information, because those matters address significant estimates or significant risks that the auditors must deal with in the audit. And as you can see here, only a few auditors actually did mention or appear to consider climate-related issues or targets in their assessments of these audit matters when they were auditing these companies. So that's about 20% of the auditors had some level of consideration. You can see the blue has means that they did much more than they've almost gotten to good practice. Anyway, I'll talk about that briefly at the end if we have time. One of the things I wanted to mention on here was impairment. So for these companies, impairment, again, as Diogenis has mentioned, is quite an important item for the assets, productive assets. And we noticed also, of course, impairment could be, as Diogenis has said, affected by climate-related matters because of future cash flows that are used to, assess impairment and value and use. And so we expected impairment assessments we expected the auditors to have to consider climate-related risks for these companies in impairment assessments, because 77% of the audit reports that we looked at included impairment as a key or critical audit matter. However, only 25% of those 77% actually referenced some consideration of the effects of climate on the impairment testing. And so that was, we thought that was a disappointing result, considering the types of companies and how impairment items we would expect to see more information in the financials about that. The consistency check for auditors actually was quite similar to how we assessed companies. So if the company looked consistent, usually the audit consistency check was going to get a similar score unless there was an obvious difference between the two. But for most purposes, they were pretty much similar, the consistency checks. I wanted to mention a couple of other findings related to across sectors. So our population wasn't large enough to make any sweeping observations for sectors, but we saw that energy companies, so utilities, power producers, and oil and gas companies, overall, they scored better in transparency of reporting and provision of information and even consideration of climate. And these were mostly, if not all, I think, companies in the EU and UK. So we think that could suggest that the ongoing investor dialogues that have been with these companies could be one of the reasons these companies are doing better. They're leading across the population of companies that we looked at. There are other reasons as well, but this was an interesting find that we saw. By contrast, transportation companies, you can see the percentages, but transportation companies, there were about 18 transportation companies that we looked at versus 49 energy companies. So when you look at the percentages, the transportation companies performed pretty badly, and we were surprised at the results, especially considering the EU, UK companies will have to be considering the effects of the phase out of internal combustion engines. So a lot of these are automotive companies. There are CO2 emissions performance requirements coming up now in 2021 that will affect these companies, their sales in the EU and the UK. And we did not note, we saw no visibility of any type of climate assumptions such as carbon pricing in the financials, and there was very little consideration of climate in the financials for these companies. So this was disappointing results for the transport companies. And finally, the other thing I was going to mention on the audit side was the differences across jurisdictions. And so you can see that pretty much for consideration in the audit report. So again, that's where we looked at the key or critical audit matters and whether there was consideration of climate-related risks such as energy transition on commodity prices mentioned in the audit report in the audit matters. You can see the Europe, EU, and UK companies auditors scored the best. So that's also a very interesting finding. The USA and Canada, or USA, lagged behind, and there were no audit reports that mentioned any consideration of climate for domestic companies. And we did consider for the audit consistency the differences across jurisdictions, even though we don't think, even for consideration, that the differences between the audit requirements across jurisdictions should result in this type of difference. The other thing I would mention for audit reports, which is interesting, is that some of the EU, UK companies that we looked at, 20 of them were listed both in their own jurisdiction and also in the US. So they're a US filer as well. And so their auditors had to provide 2 audit reports. One was under the International Standards on Auditing, the other on US PCAOB auditing standards. We expected the same information around climate in both of those reports. However, so 20% of the companies, I'm sorry, let me step back, the auditors talked about climate change. 8 of the companies are dual listed in the UK and the US or EU. 3 removed all reference to climate change in their US reports. And this is for the same company, same auditor, same year. Those were BHP, NE, and Rio Tinto. So we're looking at EY, PwC, and KPMG. They took the climate mention out of their critical audit matters, even though they talked about them in key audit matters. And so we didn't see a reason why they had to do that. This suggests to us that there could be the signing partners play a large role. Also, there could be no real global policy around these issues for auditors. Let me just see here. I'm being told I have to hurry up. Okay, well, Diogenis has already talked about BP. So all I'll say about BP is that the Deloitte audit was quite good. They were one of the better results overall. Deloitte discussed climate impairment in the CAMs and the audit matters, and they talked about the energy change and, climate change and the energy transition, and they used climate change specialists. So they were one of the better auditors that we saw. And BP scored better than most of the companies as well. By contrast, BMW, which is KPMG, did not score very well. basically BMW was talked a lot about climate change in the front half, talked a lot about their emissions targets and electrification in their narrative reporting, but there was no indication as to whether any of these were considered in their financial statements. The auditors made no indication as to whether or not they considered these issues. The car companies have quite large leased asset balances and sales financing receivables, and that could be affected by climate related issues because they are often valued with the collateral or the residual assets, the residual value assets. And those could be affected by climate issues, but there was no discussion at all in the financials about any of this. And I think the recommendations are clear, so I will skip that and I will go back to Richard. Thank you.
Thanks so much, Barbara. And I think perhaps we should come to your recommendations a little bit later on, but that would be good. But for now, what I want to do is turn to Alan and Alan Teixeira from Deloitte, who were getting quite a good plug there, Alan. In the UK anyway, and Nick Anderson. And really, did you have any sort of comments on those findings, or any clarifications you wanted to raise? Nick, shall we start with you?
Yeah, thanks. And first of all, I should say these are my own views. The IASB sets standards. It's not an enforcement activity, and please don't take any of the comments I make as referring to individual companies. So thanks to Diogenis and to Barbara and their teams, brilliant reports. It gives us a good basis to understand what's going on in the world out there. Richard suggested that we're starting to turn the corner. I would say very slowly.
Okay.
Would be my sense. But these things do take time. It's almost 2 years since we published our article on IFRS standards and climate related disclosures. We followed that up a year later with some educational material, and that educational material won't impact the first set of financial reports. That educational material impact is the 2021 reports. There are leads and lags in this, so let's understand that process. Having said that, I guess from the perspective of the board, we're always asking, are our existing requirements clear enough on one hand, and secondly, is there more we can do? And I guess just on the first issue, we may come back to the second issue. On the first issue, I think it's worth referring or reinforcing how we think about materiality. And that's what we define as material, as information that impacts investors' decisions, basically. So it's through the prism of the investor. It's not necessarily about the size of the item. It could be the nature of the item as well. And that's absolutely critical. I've heard over the last few weeks, various people in the profession talk about there's not a material financial impact. So they've quantified the potential impact from climate. They've looked at it as a percentage of profit. It's not material, but that's not how we or how IFRS requirements define materiality. It is the perception of investors. It's both nature and amount, or combination of both. And I think it's very clear that this is on the radar of investors. And I guess what at very least I would hope for is two things. One, greater consistency between the front end and back end. And on the small sample that I just had, we're in fact going backwards. There was less consistency year on year. We had more companies putting it in the front end, much more than increased the exposure in the back end. So that's one thing we're looking for. And I'd say assumptions are the absolute key piece that investors are looking for. And that way they can judge for themselves whether the outcome, particularly of the impairment test, is what they would expect based on the assumptions that have been made. And I was pleased that the work Barbara and the teams there was very much focused on assumptions. I think we need to keep a close eye on that going forward. So let me stop there.
Yeah, thanks, Nick, and yeah, I'm glad we referred to your article. I did mean to mention that at the beginning when we were starting, but that has been referenced. Great, Alan. Do you want to make any comments or clarifications on what we've what we've seen there. And I think we've also had a question about the role of the auditors and whether that's being held back. What forces might be holding their involvement back? Do you want to make any comments on those things?
Sure, I'll follow on from Nick as well. In terms of just thinking about, I think I also agree these are excellent reports and very helpful. They show quite a range of reports in terms of, I guess, the quality. And I think it's fair to say there's some excellent reports out there. It was obviously nice to see BP in there, but there are lots of other reports that I've looked at that have got excellent disclosures. One of the things I want to focus on, though, is a little bit about the alignment between the front end and the back end, and in some cases where it's actually quite difficult to align these things. And I'll just use a couple of very simple examples. One of them is actually when you picked up, Barbara, in the BP report in terms of an alignment for the decommissioning costs and provisions, whether they align with the emissions and reduction ambitions. And so an entity might have some ambitions or some expectations about how they're going to utilize their particular, in the case of BP, for example, they're going to utilize their resources and what lifetime they're going to be prepared to draw the carbon-based products out of the ground, and at what time their commissions might kick in. Whereas the standard that deals with decommissioning might have a different threshold for when you actually think about when decommissioning costs might actually take place. So if you haven't actually developed a firm plan, your timing in terms of a standard might not align with that. And perhaps this, which means that you don't actually get any financial statement consequences. It's not, and I don't want to say, Nick, because the standard's wrong, but there can be a slight disconnect there between having to have a firm plan in place versus some sort of expectations. And we know that the IS 37, which deals with provisions, does rely on you having, particularly for long projects, about having firm plans in place or a requirement to do something. An even simpler example I use, and I've seen an excellent report came out of New Zealand where I come from for one of the companies there. It's a water services company. It's got a lot of underground infrastructure. It's talking about the risk of climate change in terms of quite big changes and temperatures, which cause longer drought periods and greater rainfall. That puts a lot of stress on their infrastructure, which means their maintenance costs could go up significantly. And two things they're planning for. One is increased maintenance costs through breakages of their infrastructure, and two, a need to use completely different types of infrastructure piping that's more flexible to be able to cope with these things when they do replace it. Now, the maintenance, it might be built into your impairment expectations, but if you've got a lot of headroom in there, chances are it's not going to manifest. The standard says you don't anticipate maintenance, you recognize maintenance or improvements or replacements when they occur and so on. So even if you've got expectations that you're going to have to spend a lot more on your infrastructure replace, that might not actually manifest itself in the financials. That's not to say the standards are wrong, but I think there's an expectation often when we see that people are talking about how they're planning for climate change, that they expect to see that manifest quite quickly in the financials. And I think there are quite a few examples where that might not actually happen. Now, that doesn't mean the standards are weak. It just means that we rely on, to Nick's point, and the IASB's talked about this, what's material, other information can be material. And probably one of the most challenging things that we have is if you sat down with an entity and said, right, we want you to look at good climate related disclosures. They'd say, well, what do you expect me to do? What standards should I apply? Well, I think the Task Force on Climate Related Financial Disclosures, or TCFD, has been really helpful because they provided quite a lot of structure around what disclosures you might find. And the European evidence and UK evidence supports that. But, if you're looking at metrics and things like that, do I look to GRI? Do I look at the US ASB? One of the reasons the IFRS Foundation is trying to establish the Sustainability Standards Board is because there's such a proliferation of these things. And it's really hard to sit down and say, this is what the market expects, because there are so many different standards out there. And I think, I would have thought that, well, Nick says we're turning the corner slowly. People are looking for a few signposts, and they want them quite quickly to be able to get some sort of consistency in their reporting.
Richard, can I address some or respond to
Chip in, Barbara? Yeah. Yep.
I think that Alan made a very good point about the requirements, and this is where I think people are struggling. And this, I want to say that these are material issues. They're going to be material for these companies. They're material now. The information has to go into the financial statements. If the standards aren't requiring it, at least something like why are the decommissioning obligations aren't necessarily being adjusted for the ambitions, the target, that needs to be addressed. So we have not adjusted our ambitions. We have not adjusted our decommissioning obligations because to align with the targets because this, and this. Investors want to understand why there's a difference, and they're expecting this information to be similar. So if there is a difference, and if there's a reason why, and it helps investors understand, how firm are the company's ambitions versus targets, that the company is fully aware that there is a difference, because that's the other thing we're not sure of, is the company's saying something outside the financial statements, but they don't really mean it because the financials don't seem to reflect it. So even adding some color around that, and IS1 allows for that. IS1 allows companies to provide information that's material to investors, even if it's not required by the standards. And so I think what you said is actually a very good point, because there are a lot of companies out there saying, well, this and this and this. Well, the investors need to know what they're thinking so that they can be more efficient and effective in their analyses and also in their engagement.
Mm-hmm. Yep. Okay. Yes, I mean, I suppose we've got a pretty good idea from that the sort of consensus of what good reporting would look like. Couple of thoughts from me. Certainly, we looked at. I did a short report based on largely on what the team, Diogenis' team, had come up with, but I also looked at one or two of the really quite small oil and gas companies, just to see what small companies were doing. Both of these surveys are looking at what large companies are doing, and unsurprisingly, I think I found even less. A lot of these are in exploration, and a lot of the exploration companies were saying, well, we don't need to write down our exploration costs necessarily because of climate change, because these predictions are that new exploration will be required even on the assumptions of a declining oil production. So oil production will naturally decline because of fields being used up, so new exploration is still required, and we think our exploration is a good one. So I guess do people want? Do you think companies, if they believe that, they should be explaining that, even if they're not writing things down? They should perhaps be explaining why they're not writing things down. Is that one of the key things we should be seeing here?
I mean, I can come in there, and I think certainly if you go back to the material that we published back in 2017 on our materiality practice statement, there's a very good example which is exactly along that line. That if there is expectation that you should be writing things down amongst investors, if that is a material issue for investors by nature, then actually saying that it's not is material information. And explaining why it's not. Now, I think it is tough on companies, and particularly the smaller the company, the tougher it is. We all know where we need to get to by whenever it's 2050, but the reality is, there's not a clear pathway yet to how we get there. Governments also have a financial reporting. The accountancy profession, investors, we all have a part to play, but government has a part to play as well. And I think particularly for smaller entities, if there is clarity around what the pathway is to net zero, then it's easier for them to report on where they sit in that and whether they need to impair or not. So there's some things we can do today, but everyone has a part to play.
I mean, reality is also that this has to end if we want to meet the 1.5 degree. So, and only the low cost producers will survive for a limited period of time. And so there are a lot of factors going into whether a company is saying they can still you know, they can still explore and produce, and they think that they're aligning with Paris. So I think that they have to really think about whether the science, if they don't agree with the science, then they have to at least look at the policies and regulations, because their financial statements are going to be affected by these policies and regulations, even if, you know, they're not on board with the science. But it's only going to be the low cost producers. So I don't think that the smaller company, I'm not sure if the smaller company.
No, I mean, yeah, who knows whether they are. I mean, I'm just reporting a common thing which some of these companies are saying, that you know, they believe in this migration to 2050 or whatever date is being set, that nevertheless their assets will be needed and are worthwhile.
If I can,
sorry, Diogenis,
something on that, Richard, on Nick's and Barbara's point, just to flavor a bit with some extra information of what we found, is that there is quite a large number of companies that they simply state in their financial statements that we do not really need to take any action today, or we don't have to recognize anything today, because we follow the regulation of the respective jurisdiction. So they do not make this extra mile, let's say, in order to follow any initiative, or they just wait basically for the government to impose something new in order to take some actions, which is also I think that goes against whatever we discuss about net zero economy, or about how at least accountants can help towards this direction.
Yeah. Okay. I think the other thing, we had a question on this one. I think one of the other things one notices is that a lot of these, when they have climate related KPIs, a lot of this is about scope 1 and scope 2 emissions of companies. A question that's been raised with us is, well, what about scope 3? Why are companies not including scope 3 in their discussion of their emissions? Anything anyone wants to
because it's difficult
to that? Because it's difficult. Yes. Okay. Right. Okay.
It's quite hard, and at least some academic research has shown also that it is not. It is because at least investors, they do not regard scope 3 emissions as reliably measured, and this is why at least from an academic literature point of view, we find quite good evidence about the scope 1 and scope 2 being used for a market valuation of companies, but scope 3 not. Which is also comes also to, maybe this is why also, at least with what we have found in the extractive industries, is that not so many companies in fact disclose scope 3. Again, we saw a tendency. I don't have the numbers on the top of my head at the moment, but we found a few more companies this year disclosing scope 3 than last year.
Okay.
We also, Richard, we also found a lot of net zero targets for some of these extractive companies on scope 1 and 2, but not scope 3, which about 98% of the emissions for these companies, oil and gas companies, are the scope 3.
Scope 3, of course.
Or they might have ring-fenced some of their scope 3 emissions. And so these targets, when you start really, and they're targets, so you would assume they're not just ambitions. When you start really looking at them, they are not as perhaps comprehensive as they should be.
Okay. Right. Well, time is moving on, and Barbara, why don't you just give us that last slide of yours, which is about because I want to sort of go on to, well, what should we be doing? What should the various players be doing in this space? Why don't you give us that last slide, and we'll perhaps discuss. We could perhaps discuss that.
I also see a question in there about the SEC. I can answer that, I suppose, in the answer.
Okay.
Sorry, I'm trying to get back to my slide.
Yeah, I'm trying to. Yeah. Okay. SEC final rule. Yes, I see that. All right.
Yes, we actually have a blog about that. So I will try to. We have a blog about that.
Answer that one. Anyway, why don't we look at what you had in terms of recommendations, and get people's views. And perhaps we're starting off with companies, what companies need to do and what auditors need to do there. I don't know, Alan in particular, do you have any sort of feeling about your clients and how they're further approaching the issue, and what constraints perhaps they're feeling under in terms of the disclosures that they're providing, and auditors as well, I suppose. Do you want to give us a few views on that?
Yeah, as I mentioned, I think they find it challenging to say, well, what are their actual requirements in terms of disclosure? But I think all of the major firms take a slightly different approach. But the good thing, I'm quite pleased with the way Deloitte's approached this, because the essence is the climate assessments are both embedded and integrated in the audits. I know, Barbara, you mentioned one of the good things was bringing in climate specialists, for example, in the audits. I'm an IFRS specialist, so I brought into the audits as an IFRS specialist, but the IFRS assessments are integrated and embedded in the whole process. And we're trying to do the same thing with the climate. And it's not just picking up key clients like BP. That, like, BP's obviously in terms of a high profile entity. Right across our whole audit base, every client is expected to think about climate change, and it's just embedded into the process. So it's also embedded in our training. One of the hard things about this is that you've got to upskill everybody to think about this as well. So it's not just about numbers, and it's also about the way you communicate and the sorts of strategies the entities are applying and how you apply the DCFD disclosure requirements. So you need to improve your training, and we do that across the board. It's all mandatory for all of our staff who work on the audits. So we're trying to get everybody up to speed. It does take a little bit of a while, but we also need those standards to actually, when you're dealing with people, you need to be able to say, this is what you need to do, and explain why, as opposed to just saying, well, you need to provide some good climate disclosures.
Yep. Okay. Brilliant. Brilliant, Alan. That's a very good lead into to the next, what do regulators need to do, and obviously that includes the standard setters. And Nick, just perhaps you might address that. Obviously, we know that you're having your agenda consultation at the moment, yep. Including in there is a project about climate risks. Perhaps you'd like to sort of sketch out, what do you think that might add to help this picture? Yeah,
absolutely. So I think investors have an important role to play here. Regulators, particularly those with enforcement responsibilities, I think will be paying more attention to this. As far as the IASB is concerned, we have, if you like, we've done an audit of our own requirements as that could be applicable to climate. And there are 2 or 3 areas where we think actually potentially we could clarify our words to make sure that those are clearer, that we could remove perhaps a time limiting threshold, which is particularly around the disclosure of critical assumptions, where there's estimation uncertainty. So we, through that agenda consultation, which is asking how the board should spend its time over the next few years, we're asking our constituents, our stakeholders, do they think this would be a valuable thing for the board to do? And I suspect from what we've learned already, without wanting to preempt the outcome, is that this is ranking high up the priorities in terms of what our stakeholders think. So we'll continue to plug away with financial reporting. I'm sure, as everyone's aware, alongside that, the IFRS Foundation is looking at the possibility of setting up a sister board to focus on sustainability reporting. And their first standard will be on climate, if that comes to fruition. And in some respects, it helps that making those connections that Alan talked about earlier. It will be that link piece. So if you have got things that aren't recognized in terms of expenditure, for instance, where there's a climate-related risk, I'd imagine I would suspect that would come through on your sustainability risk and opportunities reporting in relation to climate, for instance.
Yep. Right. Okay. And we've got some, as you said, investors and other regulators have got roles to play. Just very quickly from our two researchers, do you want to add anything else to what we've got to? Because obviously we're just about up at the hour.
Just very quickly, with I think that we've seen that companies and auditors can address these because we're already seeing them in financial reporting and in audit reports. So I think that the auditors need to address this, and companies do too. We've already seen they can. That's the main thing I would like to say. Thank you.
Yep. Diogenis?
Just to say that I think that we see some improvements, which is definitely a positive thing, and I believe that in the future we will see much more to be done. However, I think that the issue of climate change is so complicated that maybe we need to reconsider how we can depict that on the financial statements. Definitely the financial statements, the IFRS have done a great job so far, but maybe IASB can consider further how this issue, which goes beyond the company, as we know the company in isolation, should be addressed. Thanks a lot.
Yep. Okay, and I'm very aware that quite a lot of questions came in. There's been quite a lot of questions. We'll do, I think Carbon Tracker will do the best to answer some of those, but we are at the end of our time. So thanks for sending those in. I'm sorry we didn't get to answer your question maybe that you submitted, but I would just like to end by that. End by talking just referring to the launch. Carbon Tracker will be launching their report on the 16th, as has been said. So after that, the material will all be available. In terms of our one, ACCA has produced a short version based on a sort of preliminary sample from and that's on our website, and the full report that Diogenis was referring to will be published at the beginning of November, at the time when the COP26 conference begins in Glasgow. Just to say thank you very much to our presenters presenting their reports, their findings, and thanks to Nick and Alan on our panel giving their reaction and other thoughts. And thanks to all of you taking part in your interest in the subject and the questions that you submitted.